All right, so you've used your filters and you have narrowed down the potential list of deals down to a dozen or two that you can start analyzing. The first thing you want to do is a property walkthrough. This will help you identify all the things that are wrong with the property: foundation, roof, windows, electrical, plumbing, you name it. You identify those things in your property walkthrough. You also need to collect the pro forma and rent rolls from the current owner. The pro forma is the rent and expenses in an ideal world for what the property is paying. Now you're going to expect that the seller is going to understate most of their expenses because they want the property to look good. So if you can actually get the schedules off of their taxes, that's awesome, but most people aren't willing to provide that. So get the pro forma and then the rent rolls, which is the accurate information about who's paid what rent, when they paid it, and it should be the accurate and correct information. Then you're going to want to analyze. Now, in order to analyze the property, you're going to need this information. ARV, or the after repair value, you get by doing a comparative market analysis or use cap rates to determine the value of that property. You all will need the market rents, which I've already shown you how to estimate the market rents, the repair costs, which I can't tell you what the repair costs are going to be because labor and material cost different amounts in every market around the United States. So there's no one set of rule to estimate repair costs. The only way you can do it is to talk to contractors and figure out what they charge for things. Once you know what they charge for different types of work, you can start estimating it. Now, if it's a deal you really, really like, you can get a contractor there to give you a quote. But remember, if you don't purchase the property, you're wasting their time, and they won't like it if you do that a lot. So you don't want to waste the contractor's time because you want to have a long-term relationship with them. You also need the monthly expenses, which comes off the pro forma, but you need to apply your own assumptions to it. So if they understate trash collection or whatever, you need to put what the accurate information is going to be in the monthly expenses. Now it's time to calculate, and I offer a calculator on the website idealrei.com/rental property analyzer, and it can analyze probably 80% of deals. It's not going to be able to analyze the really complicated deals. You probably will need to do those by hand or pay for a more advanced calculator. But for a free calculator, it can handle the majority of the deals you're going to come across. And here it is. So this is the actual spreadsheet that I use most of the time to analyze deals. Let's punch in, just start punching work here, start down the left side, all the yellow boxes. Let's say the gross rent is $28,000 a year. And vacancy rate, it's important you put the correct vacancy rate in here. Do a little bit of research because it has a significant effect on your return. Let's say this market has an 8% vacancy rate. Other income could be if you have coin-op laundry or church fees or something else. This is where you're going to punch that in. Now for taxes, insurance, water, sewer, and other utilities, you should put accurate dollar amount in here. You should know exactly what taxes are going to cost you, what your yearly insurance rates are, what water, sewer, and other utilities are. Now for some other expenses, we put percentages in. That's because they fluctuate a lot month to month. So we can only make a rough estimate for the whole year, and we usually do it as a percent of rent. So we can assume that water or sewer is going to be $60 a month or $100 a month or whatever it is. And it's going to be relatively consistent. But with repairs, you might go 3 months with no repairs and then have to spend $1,000 in the fourth month. So it's good to just build in some percent every year you're going to spend on maintenance. And for this example, I use 6%. Now, older buildings will have more maintenance, and newer buildings will usually have less maintenance. So you can adjust this number. Management. You always build in a management fee, even if you manage your own properties, because management is a job. So if you're doing the own job, the management job, you should still be paid for that, and you should pay yourself. Just because you're not paying a property manager doesn't mean the work isn't getting done. So always build in your property management fee. I have 10% in here because it's used a lot, but it could be less, it could be more. Punch in the correct information here. Reserves. It is imperative that you always save some percent of your rent to go towards unknown future expenses. So this could be capital expenses, for example, your roof in the future, or whatever else. Now, some people break it out, CapEx, to its own category and reserves. For simplicity, I include CapEx and reserves together. Now, if you sell the property and you have not spent all of the reserve money, you can count it for profit. But for now, we're going to count it as an expense because we're planning on spending this money, though we hope we don't have to spend it. And the miscellaneous, always plan for some unknown costs. I'm just very conservative with my numbers, so I always have a pretty high miscellaneous expense. Now let's go over here and punch in our selling price. Let's say it's selling for $175,000, 20% down. I'll just say it's at a 5% interest rate for 360 months, which gives me a monthly payment of $769. And let's say there's $5,000 in upfront repairs. This is all pretty straightforward. Now here's where it punches out the information for you. The DSCR, debt service coverage ratio. This is used in commercial lending. This basically is saying how much does rent after expenses cover the debt. And in this case, it's 1.48. Most banks are looking for about 1.2 to 1.25. So this would qualify for financing using the commercial lending criteria. Cap rate, this is how you estimate the value based off cap rate. So again, you're going to punch in the cap rate in your local area. Let's say 7%. Now this property is worth $194,000 if 7% is accurate, which means the selling price is much less than this. If the cap rates are higher, say 10%, then obviously this property is way overvalued. And then based off of all the information that we punched in, the cash on cash return is about 11%. Now, you'll have your own cash on cash requirements. You might not buy a property unless it's a 15% cash on cash return, or maybe your requirement is 10% based off of your goals that you established in your investment plan. If this number does not reach your goals, then you should not purchase the property. If this number is above your goals and all this other information is accurate, then you can make an offer on this property. But it's all based off the information you put in. Remember, it's only as good as the numbers you provide it. If you put in bad numbers, it's going to give you bad results. So make sure you take a lot of time and effort and get the accurate numbers in there. And the more of these you do, the better you'll get at doing it. So you could even go analyze 5 or 10 deals, even if you have no intention of buying them, just to get some practice.